Good morning. I'm Manju Ganariwala, and with Trustee Tim Ryan, I serve as co-chair of the FAFS Standard Setting Process Oversight Committee. Unfortunately, Tim Ryan couldn't be with us today due to some last-minute conflicts. I would like to welcome our stakeholders observing today's meeting. Before we move to our meeting agenda, I want to remind everyone of our due process correspondence procedure and form, both of which can be found on the FAF website. As previously expressed, these measures are meant to make it easier for stakeholders to raise potential concerns about compliance with the due process procedures of the FASB and GASB. Also, I want to direct our listeners to the agenda and meeting materials for this session. You can find these on the FAF website under the Meeting and Events Calendar subsection. Now, moving on to today's meeting agenda, the committee will cover the following items. First, we'll hear the GASB report, followed by FASB report, followed by FASB liaison to the PCC report, PCC meeting observations report, and finally, other meeting observation reports by the trustees. So let's begin with our first topic, and I'm going to turn it over to GASB Chair Joel Black. Joel?
Thanks, Manju, and good morning, everyone. Great to be back with you. Great to have you all in Norwalk. I am going to speak from starting on page 110 of your materials with our highlights for the quarter at the GASB, which was another busy quarter. We issued Statement 104 that Alan will talk about in just a bit on certain capital asset note disclosures. We issued a due process document in the form of a preliminary views on our infrastructure projects that I'll talk about in just a bit, and made good progress on our other projects. We actually, just last week, approved a couple of other due process documents that Alan will probably highlight on some of our smaller projects. We continue our monitoring activities really related to electronic financial reporting, monitoring the Financial Data Transparency Act. Our work on the taxonomy continues so much, in fact, we feel like we've got a good foundation and know directionally what that project should look like, that last week the board also approved taking it, saying really this has evolved outside of a monitoring activity at this point and should be its own project. And so the board did approve, and you will see the next time the technical plan is updated in December, that that project, that taxonomy project, being broken out, not as a standard setting project, because in our view it's voluntary, it's not creating gap, but as its own kind of technology project within our agenda. So it'll have its own kind of unique category. The board also began discussions about getting more external input at this point into the process. And so we're in the process of forming a consultative group for our taxonomy, creating a charter for that. That will consist of all external people made up of preparers, auditors, users, investors, as well as technology kind of specialists and people, data people, to help inform the work that the team is doing on that project. So like other task forces on more traditional standard setting projects, I'll appoint those members, although we will have a charter to govern the membership on that committee or group, I guess, that will be made up of between 20 and 25 people. We also talked about what we thought might be covered in a first due process document that would probably come out in late 2025 on a pretty decent chunk, at least broad architecture of the taxonomy, and then some more details on some of the statements or portions of the report that the taxonomy will cover, so that we can begin to get external input from all of our stakeholders through that form of due process. So that's work we're doing on that taxonomy. Always good for us to remember what our GASAC, our advisory council, has prioritized. Back in April, they really prioritized for me 5 things above the others. The first 2 are listed there. electronic financial reporting, even in our GASB meeting last week, continues to be something that the advisory council is very interested in. The work we're doing on the taxonomy, we gave them an update last week. They continue to be very interested and supportive of that work that we're doing, saying that it's important. Cybersecurity risk, we added to our agenda as a monitoring activity. I think you might actually see it move into more of a research phase coming up soon. Potentially the board has to approve that for it to be research. And this is just us being responsive. We still, I think, don't know, and this is what the research will show us, is to really plan out what's the potential role for external financial reporting in these disclosures, if any, and what would those disclosures be, and would they be helpful to users of government financial reports? So really just thinking through what are the potential paths forward, if there are paths forward for external financial reporting as it relates to cybersecurity risk. So that is something that our advisory council prioritized for us, and we are trying to move forward, at least with discussing what our role might be in GAP related to it. The other three things that weren't as highly voted as those others were governmental fund financial reporting. At our December meeting, the team is bringing a paper to the board related to what that project may look like, and we'll see what the board does with it. And then it was implementation of our subscription-based IT arrangement standard, which back in April was coming fresh off of. The technical inquiries related to that are really pretty far down. We have an implementation guide update. We actually aren't adding any questions related to SPEDAS because we didn't have any that we thought warranted that, but it's something we continue to pay attention to. And then the financial reporting entity is something we're trying to maybe improve the complexity of through education for a while before we undertake standard setting, and see if we can get any traction there. But those are the things that our advisory council prioritized for us, and we're working on each of them in some way. So if you move to page 112, you'll see the roll forward picture of our agenda. The movement there is we did add one project to pre-agenda research on revenue and expense disclosures. Alan will talk a little bit more about that when we get to the research part of this presentation. And we did issue statement 104, so that's the one going away. So we started with 12, we end with 12, even though one was added and one went away. Moving to 113, our comprehensive projects. At this point, we are only in, our only project here is the revenue and expense recognition project. At this point, it will probably always be read, and that we're not going to meet our 9-year time horizon for this project. But as I know, the FASB's recently come out with their 606 post-implementation review. It's a complex project. We want to be sure we get it right before we release it. So we are working our way through it, and we are making progress. In fact, our project is broader than the FASB 606 project. It deals with expenses, and it deals with both for us, what we think about as exchange transactions and non-exchange transactions. We have worked our way all the way through all the non-exchange, or what we would now call category B transactions. We're now in the middle of dealing with transactions that have performance obligations. And this is really where we're bringing in potentially the 606 guidance that the FASB has, learning a lot of the lessons that they learned throughout that implementation, and trying to put out guidance that looks like theirs, sounds like theirs, is theirs, but learns and takes and puts it into a government context as best we can, and keeps it as simple as we can for our entities. So we're certainly learning from our FASB friends and appreciate all the help they have there. So that's the work we're doing on revenue and expense recognition. We probably won't have an exposure draft until late 2025. Moving on to the next slide, page 114, our major projects. Here we have two. One is our infrastructure asset project. This is the one that I mentioned earlier. Did release the first due process document at the very end of the third quarter, so it's in the comment period now. The comment period was between 100, it's about 110 days, I think, is the actual comment period. It ends January 17th of 2025. So we tried to give a pretty good long comment period there. We didn't have it comment period end around December 31st, which would be a major financial reporting deadline for many governments. We gave them time after that. We're trying to work. We've got podcasts on this, videos, really trying to advertise it. we already have 5 comment letters actually using the electronic input form, which is great because we usually only get comment letters at the very end, and I'm sure that will still be when we get most of the comment letters, but we already have 5. So that's good. On this project, what I expect is users, one of the main things we were trying to do here is provide users with information on what they would call a deferred maintenance liability. The proposal and the preliminary reviews discusses this, that the board didn't feel like deferred maintenance liability, number one, met our conceptual definition of a liability because you don't really owe it to a specific individual or organization. And so it couldn't be a liability. And in fact, the whole term was too subjective for any role in financial reporting. But what we've done is try to meet in the middle and require some disclosures and required supplementary information about what a government actually has spent to maintain its infrastructure assets. We've gotten some positive feedback from, for example, our advisory council. So I think we'll hear some users, investors, et cetera, saying, we appreciate that step. We wish it could go further. So they're going to have wanted us to go further, but they will value that. And then on the preparer side, I'm sure we will hear some version of at least parts of the proposal, if not all aspects of the proposal, are just extra time and effort, and will create burden. And so the board will have to weigh that cost benefit. We do believe we've met a balance to provide something that we think shouldn't be too costly to provide, but is significantly meaningful to our users. But we will look forward to the feedback that we get. The second project we have that's considered a major project is going concern severe financial stress. Our deliberations continued. We had our project leader for that left at the end of the summer. So we had a little bit of a pause, which won't delay us outside of our timeline. We'll still meet timelines. And we've kind of picked that project back up. And actually next month, the board will be looking at a first draft of a due process document, which will also be a preliminary review document. So we will move forward and expect that preliminary review to be issued late first quarter of 2025. But I do think that this helps spread out. It kind of worked out well to spread out 2 preliminary reviews documents on 2 major projects, infrastructure and going concern, so that the comment periods don't overlap and we can get our stakeholders focused on those things. With that, we do have a couple of other due process documents that are about to go out. We're just approved, and Alan's going to talk about them.
Yeah, if you look on master slide 115, what you'll notice is we've got 2 exposure drafts on subsequent events and implementation guide updates. We are cognizant, and when the board has been very cognizant of the idea that we talk about resource constraints within governments all the time, and we have less resources, and the others have less resources. And then we look at our calendar and realize, oh, we're going to have 2 PVs and 2 EDs, 2 preliminary reviews and 2 EDs on the street at the same time. What can we do? Well, the first thing we can do, we can spread out the due process periods and the comment periods and give them as much time as they can. Don't have any of these things come back until the beginning of the calendar year, right? Let them get out of their reporting window. We did that with infrastructure. Subsequent events is right there in the middle. That was approved by the board last week. That has a comment period that went in February. So that's going to give them some time for that. The implementation guide update, which again, for folks that in the room, those are just question and answers for us. It's GAP, but it's written down questions and answers, so it does become authoritative. There's 19 questions in this update. That's a good number of questions for us. And that document will be due back on January 24th. Really, that's all about backing into having that document done by June 30. We want that document to be done by the time folks would start their next year in cycle and reporting cycle. So that kind of has a little bit of we want it done by June 30, so you back into when you need the comment period to be over. But that's nice. And then there's 19 questions. We don't have guides every year. We don't need to do guides every year. We do them when we have the right number of questions. We didn't do one last year, but we'll have one in 2025. The last thing on the screen would then be classification of non-financial assets. And if you go to the next slide, I can talk about it also on the next slide, master slide 116. It's interesting because classification of non-financial assets was really trying to deal with 2 what I would do narrowly focused practice issues. One, we have capital asset roll forwards in the notes, right? You have, here's what your capital asset balances were, additions, deductions, here's the ending balance. How do you roll into things like leases and things like speeds and things like P3s, which are these right to use capital assets? And how do you roll them into the capital asset roll forward? Do you show leased buildings with owned buildings? Do you show owned software with speedas? And we thought just to clarify that a little bit and provide some clarification of how you put that in the roll forward would be helpful. That's one of the things this document does. So it's narrow in the sense it's not changing measurement, not changing recognition, just telling you how to roll those things into that capital asset roll forward we talk about. Didn't change the structure of the roll forward, so it's still the same. The other thing that we dealt with was this notion of governments periodically will actually sell capital assets. And right now, there's no distinction or no disclosures around the capital assets the government's actually are holding for sale. Like an entity wouldn't know what those are. And so 104 also deals with the idea of what would be the criteria to actually disclose a capital asset being held for sale. And so we have that now. We have not had that in the past. The one thing we didn't do with that is we did not go down the path of having any remeasurement issues when they actually hold it for sale. As you can probably imagine, the government space, governments can have assets that they might want to sell and for various reasons can't sell, or the price they get back for it isn't the price they wanted to sell. And so you get a lot of situations where governments will want to sell something and ultimately not end up selling it. And so we were trying to not have to deal with all those remeasurement issues if you did that. This is really about just disclosing it separate from those capital assets. So folks do have some notion of, hey, there might be a liquidity conversation with this government about assets they might be wanting to sell, and might be what they could get from that, but it's not really changing the notion of what those numbers would be from a measurement standpoint. We did do this slide here on slide 116, was really just showing the interactions. Now, I say that to say if you compare this to the interactions on 103 that we provided to you at the last meeting, you're going to get a very different picture. Now, one was a financial reporting model reexamination, a very large project with a very big input that went over, I think, 7 or 8 years and a lot of interactions. This is a much more narrowly focused project. So you won't get the volume, but what you'll see is you'll get some of the consistent types of things that happen. You'll get some liaison meetings and GASB meetings and stakeholder interactions. You just won't have the same volume because they're not the same size projects. But it still made sense for us to still give you what this would look like for a smaller project. And that's really what slide 116 is trying to do. If you flip to slide 117, we'll really talk about research. And there's really 3 things on here, and I can touch base on them relatively quickly. Our large project, Joel talked about RER, revenue expense recognition. That project's really been about recognition and measurement of revenue and expense transactions. Well, it started dawning on us here recently that we learned this looking at 606 and learning some of the work over there. There's probably disclosures related to some of these transactions, and we probably should be talking about disclosures related to some of these transactions. But our current scope of that project didn't talk about disclosures. It was just revenue expense recognition. Now, the argument could have been, well, we could just modify the scope and put those in there. And we said, well, yeah, we could, but we think the better thing to do, the more transparent thing to do, and really from a stakeholder standpoint is, let's not do it that way. Let's put this in pre-agenda research. Let's go find out what disclosures could be. Let's start from what there is actually in 606. And let's look at that and decide what disclosures really make sense in the government space and do that as research first, as Rich likes to talk about, is what would be the path forward of that project if and when it got to the technical agenda. And we're kind of thinking this the same way. And so that says, let's look at it and not just have it be an amendment to the scope of RER. So that's what that project really is. The other 2 here are things we've talked about, gap structure. We're one of the few only standard setting bodies I know that have different levels of authoritative guidance in GAP. We don't have just our COD, we have our original pronouncements, and we have our implementation guide questions. Does that make sense? What's pros and cons, plus and minuses of that? We're really trying to ask that question. Should we change? And if we should change, how should we change? That project's going to be on here for a while. That is not an overnight conversation. The last one here is a conversation that we have with this body a lot, and it comes up a lot. How many governments are out there and how many of them use GAP? Right? We throw out this 90,000 number a lot, right? There's 90,000 units of state and local governments, and how many of them use GAP? This project is trying to answer that question. And this project, the board will get a report on that project in December. And we feel pretty comfortable what we've come up with. We feel pretty comfortable what the research says, but we're going to have an ability to answer that question now. And the way Tammy and our research manager has done this, have a way to do a predictive model, we can show what it's going to be over time. So if things change, dynamics change, constraints change, how would that change? Predict how we think the government would react in terms of would more people use it or less people use it? It's really an idea of where's the radar? Like, where is the movement, right? Is the movement that more or less governments are using it? But the major thing will come out of this is we can answer that question of, well, how many governments do we think actually use GAP, right? And as people know, that's on a continuum, because if you say they don't or they do, as I think a lot of people know, there's a lot of people in the middle. They do it, but maybe they don't do all of it. And so we're also trying to answer that too, which actually, that's the part we've really never done before. We used to answer this in a binary standpoint of yes or no. And we've done this project to say, well, it's not just yes or no, it's no, fully, and then a bunch in the middle. And so a lot of the project's been about what's in the middle. The last thing I'll talk through is just our PIR process. We're very happy to give y'all, and this is on slide 119, we're very happy to give you a pension PIR report. Last time we met with you, and we're continuing to work on those. I think in the spring, we'll start talking about a Statement 72 fair value PIR report. That would be on our version of fair value. I think we're on track to do that for y'all. And then we'll have the last three on here, which would be OPEB, fiduciary, and leases. Leases being the one that a lot of time we're talking about now, because that's really working on cost data and survey data and interaction data and responses, because it just got done, right? So it's the one that they just dealt with and they just finished implementing. But all these are important to us, and I look forward to giving you a look at what the Statement 72 fair value PR looks like when we get into the spring of 2025. With that, I can stop. And questions for me, questions for Joel, questions for anybody?
Andrew, could I ask a question? You mentioned the delay a little bit in the going concern and severe financial stress project because of the project leader moving on. And then how does that get reassigned? How do you say, who wants to do this? Is there somebody else in the project that takes it on? How do you do that?
Well, in that case, it's a little interesting, because what actually happened in that case is the young lady who was, normally we don't have one project manager on a project. We'll have a lead and then we'll have probably a backup, a second chair or a backup. The young lady who was the second chair on going concerns, fairness, stress was a young lady trying to get 104 to the finish line. So really that was more of that. And she was also the young lady who was answering a lot of our lease questions and doing a lot of our lease Q&As. And so there was just a momentary pause of, well, now that the young lady who was running GCU left, let's be fair to her and give her a pause of a couple of months just to get her breath, get the Q&As done, get 104 done, and then we'll just pick it back up and keep moving. Timeline-wise, as Joel mentioned, it doesn't affect us a long run. It probably costs us 2-3 months. But just in fairness to her, in terms of just bandwidth, we can give her that time. The broader, now that was kind of just worked out that way. Broader, you really look at skill sets, you really look at backgrounds, you really look at where somebody's actually where they come from. Does someone already have a pre-existing notion of a certain topic and they can step in pretty quickly and take over the project? You're going to try to look at probably someone's historical background knowledge, where they've looked like in other parts of the project, or have they run other projects that are similar to it, right? This one's just, the answer was right there. You knew what the answer was. It's just, how do we give her time to actually get 104 finish?
Any other questions? If none, then thank you, Joel and Alan, both. Wonderful report. Very busy third quarter, a lot on your plate. And with that, now we'll move on to the FASB report. Chair Rich Jones.
Great. Thanks very much, Manju, and welcome everybody. This will be Jack Day, our technical director's second oversight committee meeting. And as we walk you through the activities for both 9:30 as well as a little update on what we've been up to post 9:30, you'll see that Jack's been very busy here in his transition period. If I can first direct you to slide 122, this is the summary of the 7 top investor priorities identified as a result of our agenda outreach. You'll notice on a careful reading that the colors have changed, and that's because we continue to make progress on these projects. While I've listed 7 here, they actually translate into 10 individual projects on our agenda, our research agenda, and our research agenda. So maybe just a quick update. Digital assets, income tax disclosures, those were both finished last year. Disaggregation of financial reporting information, commonly referred to as DICE, was just recently issued in final form. We're very excited about that. Under ESG-related transactions or disclosures, keeping in mind our charges, financial accounting and reporting solely, we do have 2 projects related to that. One is derivative scope refinements, for which an exposure draft has already been issued, and that was to address accounting for ESG-linked financial instruments in the financial statement, something we've seen grown in prevalence. The other project there is our environmental credits project, which we will be issuing in an exposure draft shortly. The board has voted to move forward on a final standard, and we're just in the final stages of wrapping that up. Under intangible assets, including software, there's 2 projects there. The software exposure draft has been issued. Intangible assets is on our research agenda, but we have an invitation to comment that will be coming out before the end of the year to solicit broader feedback for our board to understand really what would be the nature of a project in that area and what would be the most fruitful avenues for us to pursue. Below that, financial KPIs are non-GAAP metrics. You may have seen some news reports that invitation to comment went out last week. This has been a longstanding question of should there be an expansion of GAAP? Are there financial key performance indicators that are currently residing outside the financial statements? Is there a role for the FASB there? Would there be a benefit to standardizing some of those financial KPIs? And if so, should they be included in the financial statements? Or alternatively, should other forms of financial KPIs be included in the financial statements? And if so, for whom and when? And then finally, under the statement of cash flows, we have two projects there. We have one on our research agenda, which is effectively dealing with the statement of cash flows for financial institutions. Think of a statement of cash flows for companies whose business is cash. Right now, I think we've heard from all stakeholder groups that's not necessarily providing them the best information. So we're looking at that for that subset. At the same point in time on our research agenda, we have a continuing project related to the statement of cash flows to really consider, are there other improvements we could make for all entities to help with the utilization of that standard? So continuing to make good progress. The next slide, 123, gives you an overview of our technical agenda, including 3 EDs that were issued in the quarter ended 9/30. But there's been a lot of activity other than that. But before we get to that other activity, let me turn it over to Jack, who's going to give you some insights into our due process steps related to those projects. Jack.
All right, thank you. So we're going to be looking at 3 different projects if you're on 124. And I'm going to give you a little bit of the why we issue and the status. So let's just go ahead and turn to 125. And I'm going to steal Rich's line here. This is the Not a Derivative project by the Not a Derivative team. So really covering 3 things here. First of all, a couple of emerging transactions that where the the accounting has changed a little bit, the transactions changed a little bit, and they become derivatives. R&D funding and litigation funding. We read about them a lot in the papers. And so this is going to provide an exception because these are in the control of the company's operations for them not to be a derivative. This proposal also addresses the green bonds that we mentioned earlier and will provide guidance on how to account for those. And finally, kind of different topic, share-based warrants that are received from a customer in exchange for revenue contracts will be addressed in this project as well. That's a popular transaction that we're seeing more and more. So the comment letter period has just ended. We have 35 comment letters in from a broad variety of constituents. In that regard, they're generally positive. We're getting a lot of rah-rahs. There's an element in there on how to use the word predominance that we got to define a little bit more. But frankly, we are aware of that topic before it came out. And, the feedback is all over the board. So we'll work through that. Seeing no questions, I'll move on to 126. Hedge accounting improvements. We have a document that is a proposal that is outstanding. This is an example of how our feedback loop works. Our constant feedback. We receive feedback that our last project on hedging to make it more aligned with the economics wasn't working to the extent that we wanted it to, and we've issued this document. So far, what we're hearing through our various outreach mechanisms is that people are generally positive on this proposal. There is this ongoing desire to go a little bit further with hedging, but to do that, we're getting closer to the end and without re-looking at some of the pillars. So, seeing no questions, we'll go to 127. Clarifications on share-based consideration payable to the customer this time. This is an incentive. That's why I paused earlier, keeping these 2 straight. This is a question of where we are working to resolve a couple technical conflicts between the guidance to drive better consistency and also just to make life easier. Not a lot of desire here as to what the answer is, but just a single answer. So
Hey, Jack, maybe
Yeah.
just before you move on, if you notice on each of these slides, we split up feedback that we're receiving by stakeholder group. And so one of the questions is maybe, well, you seem to get an awful lot of auditor and preparer input on some of these issues, but not as much user input. And part of it is based on the nature of the issues. Very often, and particularly these three issues that we've laid out in front of you, they're dealing with pretty much I'd almost say the bowels of the accounting, where to a user, the outcome, they may see the broader outcome, but these details into this level and the diversity in practice that can be affecting what the user is seeing, but they don't know that it's underlying that accounting. So very often it's a preparer or it's an auditor who says, hey, there's this issue here, and people are doing it all differently. Or there's this issue here that your original intention that you got a lot of investor feedback on that you wanted to, for example, better align risk management and economics with the financial accounting outcomes, it's not occurring. And it's because of these few items. So I do want to highlight that. We do spend a lot of time with investors. We'll get to our investor outreach report a little later, but occasionally on some of these types of items, you're going to see the feedback skewed more toward preparers and auditors, and that's one of the reasons.
All right, great. With that, we'll move on to 128. Rich covered a significant portion of this earlier, and I won't repeat that. I just want to point out a few things. So we are rolling along thoughtfully but timely, and I'll give you an example of that in a minute. But Rich gave me a lot of credit, but the credit really goes to my great team who has been working very hard to see these things over the finish line. We are monitoring comment letter deadlines. That's a point I want to make. And we are staggering those. In fact, we just went back to the board the other day and extended 3 of them because they were going to be during the natural financial reporting system or season. And we extended those beyond the season, as well as also to give a little bit more time, given the nature of the documents. That was for government grants, interim, and for the environmental credits. Also wanted to note that everything in bullet 2 that is expected to be completed in the 4th quarter, we expect to be completed. 2 or 3 of those items have come out recently. There's another one coming out in November, maybe very quickly, and a couple more in December. So they're all moving along. With regard to the PCC projects, they're moving along. Another example of our processes working, we've gotten some feedback during the fatal flaw review on contract assets that we're working through, and then we may slow it down and work through that because we want to be thoughtful. Even though we're trying to be timely about all of this, if we run into an issue, we're going to resolve it before it goes out. We want to make sure we get things right. So, yes, sir.
So Jack and Rich, and I see Sue here as well, on the endorsement of the PCC agenda items, could you talk a little bit about quickly, how does that work, the endorsement process? How does the board deliberate to come up with the endorsement?
So, interestingly enough, it's really not any different than any other project we add to our agenda, but we benefit from the PCC's deliberations because we're part of those. We also benefit from the fact that the PCC is really an expert group when it comes to that issue, when it comes to private companies. So I will tell you, as just taking off my chair hat for a minute, putting on my board member hat, where I'm one of 7. When I look at it, I have a package in front of me. I have information in front of me, and we make the same decision we do on any project. So I know there's some, that there's occasionally some discussion about the PCC has this special status, but at the end of the day, there's nothing that goes on our agenda and becomes final standard through any different process than any other standard that we set.
All right. Well, I'll stop there and turn it back over to Rich at this point, barring no more questions.
Great. So if you look at slide 129 and 130, 129 is a summary as of the date we prepared these slides of our technical agenda. And then 130 gives you an overview of other projects. And I want to reemphasize a point that Jack made. There are a lot of third quarter, fourth quarter dates in here on exposure drafts being issued. We recognize that to be successful as a standard setter, we need input from our stakeholders. So we are constantly looking at the timing of when we're issuing exposure drafts, the comment periods, we're adjusting them. And then as it comes to looking at our non-technical agenda projects, our invitations to comment, we're also looking at those. The other thing is we're very clear in our messaging. While we have comment deadlines, if somebody calls us up a week later and has an issue or has something they want us to consider, we take the call, and we certainly don't close our ears because a comment deadline has come. We look at people's letters when they come later. I know all of our board members read all the comment letters. That's what we're focused on. But it's something we're very sensitive to. We want to make sure that we have the appropriate amount of time. Some of these issues, some of the large accounting firms will comment on every single one. Some of the preparers, some of the investors will have more interest in one project versus another, similar to the input we talked about as part of the due process overview. So I do just want to assure you we're listening, we're paying attention. As Jack mentioned, we're making changes. And when we get to some of our non-technical agenda projects, our ITCs, we're talking about comment periods of 4 or 5 months. These are extensive comment periods with a lot of time for people to take a look at things and assemble their thoughts. So, and again, to the extent they don't have time to write it down, they want to just call us and talk to our staff. We're very happy to hear it, and that will certainly be shared with our board. Slide 130 does summarize our non-technical agenda projects. I know last time we met, we celebrated the first time final completion of our concept statements. Well, it would be great to celebrate it again. I won't, but it's reflected here in the 930 roll forward. PCC projects, I know Sue Cosper will be giving you an update on that, so I won't touch on that. Do just want to highlight also the EITF, and this is, quote, the new EITF, and what you're seeing in this roll forward here is the first issue that the EITF added to their agenda was transferred over to the FASB, and the FASB, through our normal agenda process, decided to then add that to our technical agenda. So as I told the EITF members, they're batting 1,000 so far. I hope they keep it up. But it's been great to see the improvements in that group. I'm going to skip over the next few slides and want to give Jack a chance to talk about the post-implementation review, which is on slide 134. Just as a reminder, we have gone through our draft report with the Oversight Committee, and our plan is to issue that draft report shortly as a final report. But Jack, go ahead. PIR?
Yes. Sure. On the PIR on page 134, first of all, we talked about revenue recognition. That's in the reporting phase. Leases and credit losses are in phase 2. That's when we actively go out and perform outreach. We are in the beginning processes of that on leases. In fact, I looked at the outreach materials that we're going to use to facilitate those discussions here in the last couple of days, and we're getting ready to move forward. Also, importantly, we've been working closely with the PCC on their lease outreach that's going on too. And they're helping us gather information about how leasing is impacting small companies. And so that's a regular thing that we're involved in. With regard to credit losses, we're really working on our plan right now for formal outreach, but we are in that stage as well. So that goes on to, that is incremental to all the research and outreach and information and listening that's occurred ever since the standards went out. So, it's not like we're, starting from scratch, but we are in that formal, let's find out how they're working period. So I'll stop there.
Okay. Moving on to the next slide, slide 135, it highlights our investor outreach report. So I'm happy to say we've issued our 4th annual investor outreach report. When we issued the first one 4 years ago and called it an annual report, we were hoping it would be well received. And I will tell you, the feedback we've gotten has been very positive. I think it was very important for us to be able to communicate with our stakeholders. Our outreach, particularly with this stakeholder group, where we were less apt to have written comment letters as part of the record for the interaction. And as you'll see, over the past 4 years, we've had over 1,700 investor interactions. And that's all part of our pulling those folks and those folks dedicating their time to come into our process to help us set standards for capital allocation purposes. So very happy to have that out there. Hope you've all had a chance to look at it. And there will be a 5th annual investor outreach report next year. With that, let me turn to Jack, give you a little more insight into the EITF, unless there was a question. Was there a question? No.
I have a question. Maybe
Yes,
I should
Manju.
ask it this time. It's interesting to hear about and see just the volume of output that's going on in third quarter, 3 EDs being, published, and then 10 either have been issued or will be issued by the end of 4th quarter. Does that inundate the stakeholders? And at the same time, I was also pleased to hear that just because there is a comment period that you're very cognizant about, the amount of time and allow longer comment period. And if a stakeholder wants to comment on something but have missed the comment period, that you are still, very receptive. FASB is very receptive to any comments anytime, whether within the comment period or afterwards. But I was just curious about, do you hear something from the stakeholders like, hey, this is too much coming out of the spigot at the same time?
I think when you talk about simply the number and the time frame, it can be. But then when we have the follow-on conversation, so normally when we set a comment period, we would say, okay, this is a document. People should be able to respond to it in 30 days. Instead, what we've done as a board, we said, okay, well, they could respond to it in 30 days. Here's 3 other documents that are out there. So let's extend it. And part of the challenge we had here was it better to put all these documents in our stakeholders' hands and extend the comment periods, or was it better to hold them back and they're done and issue them later with shorter comment periods? We took the former route, and I do think that's helpful. So while you will see a lot of documents in exposure draft phase, and you will see invitations to comment out there, when you look at the comment periods and how they stack up, they give them a lot of time. Now, if somebody wants to, be the high performer, read them all and get us all the comment letters in right away, we're certainly happy. But we also recognize people have competing needs. But we're always willing to be engaged with our stakeholders. We have various ways besides writing a comment letter they can give us input. And whether it's an electronic form, whether it's a call with our staff, whether it's asking to meet with a board member. So we will do those things with them as well.
Are you seeing more comments come through once the electronic format was introduced, where they could just kind of go on the portal and type in?
It was introduced quite a while ago. Sue Cosper can give the exact timing, but I think while some use it, I would say most who submit formal documentation of like a formal letter or a form, it's still more common letters than it is electronic by far. But it's another avenue, which I think is what, and if 5 people use it, then great. Maybe that's 5 people we got input from we wouldn't have gotten otherwise.
Thank you, Rich.
Okay. Let me turn it over to Jack for a little more in-depth on the EITF.
Yeah, so on the EITF, we have, first of all, the one document that we mentioned earlier out for comment on determining an acquire and an acquisition. Second of all, we have 2 other topics that have already come up through the process. One of them has been discussed in an EITF meeting and will be discussed with the board for endorsement on Wednesday. And another item we felt the agenda committee felt, and the board agreed that it would be best handled through our codification improvement, and that is in our fatal flaw review phase, so should be moving right along. So that was an old item that a sentence got dropped back during the creation of the codification that wanted to get clarified. So.
And maybe just in closing, just like to focus on next steps. We obviously walked you through a lot of activity. A lot of the standard setting activity certainly benefited from the extensive agenda outreach process we had. We will also be issuing toward the end of December, possibly the beginning of January, another invitation to comment related to agenda outreach. It's a logical time based on where we stand with our agenda. That will have, again, a very long comment period. But we've already done outreach with a significant number of stakeholders to populate that document. They've shared, those that we've done the oral outreach with have shared what they thought our priorities should be. But by putting it out in an invitation to comment, it gives all of our stakeholders an opportunity to weigh in either on what's in that document or things they think we should be focused on. So we're looking forward to that. We do expect that to run out through next year and the beginning of the following year as we once again focus our priorities on our stakeholders' concerns. So with that concludes our presentation. If there's any additional questions.
Go ahead, Rick.
Say, Rich, on the agenda consultation, and maybe it's too early to ask this question, other than you mentioned you have received some verbal discussion items already from stakeholders on what potentially would be an agenda item in the future. Do you have a sense, even from the verbal discussions, that some of the issues that might have been on the last one, because of the changing in our environment, might have elevated now to where it would be one of the ones that you would want to deal with? Is there any sense of that?
So interestingly enough, as part of the outreach we did, we took everything we heard last time and did not add to our agenda, and we asked stakeholders about those. And to be fair, there's a couple topics. There's, for example, consolidations. We didn't hear last time, and we were not hearing so far, that people want a different outcome. But what they would like is a different model to get them to the same outcome. We struggled with that last time as a board, and how do we redo a very complex model, make it easier, but get the exact same answer? And we struggled with it. So we're hearing a little of that again, and we'll get some input onto that. But one thing that I do know is if we impose a lot of cost and effort on people and it didn't change an answer for an investor, you have to really be careful what your case of change is, because you don't have that traditional capital allocation case of change. Now, if we saw a misapplication or if we saw a wasted effort that could be excluded, that would be great. But I don't know that we've identified that. We are hearing some common themes, but that's the good thing about putting the document out now, is to make sure that those common themes aren't simply because of those who've weighed in so far, really understanding the case for change in the broader financial reporting and use community. Okay. Sure.
Seeing no other questions for Rich. Thank you, Rich and Jackson. That was a very in-depth report. Appreciate that. And I'll move on to Sue Cosper for the PCC report, the FASB Liaison to PCC report.
Thanks, Manju. So good morning, everyone. Our last PCC meeting was held on September the 24th. And at that, while the PCC was here in Norwalk, they also took the opportunity to have their annual liaison meeting with the TIC, which is the Technical Issues Committee of the AICPA, on September 23rd, the day prior. This PCC report is in your materials, beginning on page 138, and the agenda and the meeting recap are on page 229. Maybe just to share a couple highlights for you from that meeting. They continued their discussion on their agenda priorities. They added 2 projects to their agenda, one allowing a practical expedient in an accounting policy election when applying the current expected credit loss model to trade receivables and contract assets. And the second one they added was to allow a private company alternative for presenting revenue recognition for conditional retainage and overbillings. They also completed their deliberations on each of those projects and recommended that the FASB endorse their decisions, which the FASB did on October the 16th. The PCC also had an update at that meeting on two other initiatives they have as far as agenda priorities are concerned. One was having an update on the results of outreach conducted on their research activities on debt modification and extinguishment guidance. And also the PCC had recently formed a leasing working group. And so they also had an update from those that participated in that meeting on their activities. And that leasing working group is really tasked with identifying whether there is a need for any improvements to the application of the leasing guidance for private companies. And much like Jack mentioned earlier, it's really viewed as a complement to the FASB's post-implementation review process. So one can help to inform the other and vice versa. The PCC also provided feedback to the FASB on their agenda consultation initiative. And I would say, you know, just as a general comment, the meeting, there was good engagement, good participation, both from PCC members as well as the participation of FASB members along on each of the identified areas that were discussed. The meeting that they had with TIC was a very productive meeting. I would say it was primarily focused on discussing the PCC's agenda priorities and getting feedback from them on their approach. So maybe just turning to town halls and liaison meetings, as well as some other activities. In addition to the liaison meeting they had with the TIC, subsequent to the September PCC meeting, the PCC held a liaison meeting with the Risk Management Associates. That's an organization that represents banks who lend to private companies. They also met with the AICPA's Auditing Standards Board Task Force in conjunction with the FASB in early November, and separately with representatives from the Construction Financial Management Association, which was the first time they had had the opportunity to meet with that group. All three meetings were very productive and covered a wide range of topics. The next PCC meeting will be held in Norwalk on December 16th and 17th. And we also plan to host a webinar for private companies and not-for-profit entities on December the 12th. So with that, I'll pause here for any questions.
Questions for Sue? Thank you, Sue. Appreciate it. All right. The next report is from Trustee Rick Reisick on his observations of the PCC meeting.
Thanks, Manju. And I would echo what Sue mentioned. As always, I always like to report a couple of things from an observation standpoint. All of us get a lot of benefit from participating as observers in the different meetings. This one I participated virtually, which in one of the comments I'll make here shortly, I felt at a disadvantage not being in the room while the conversation was happening. And so I will be at the December meeting just because I like to be there in person to see the interaction, to see body language and that type of thing. But the interaction was great from a listener standpoint. A couple of things though. One, of note, as Sue mentioned, when the technical issues committee from the AICPA comes, they comment on the PCC's agenda, but they also have their own agenda, right? And they come with things ready to go and prepared presentations by various members of the group that are assigned to that, which is always very interesting. And that's how the PCC certainly and FASB get a lot of input and a lot of ideas coming from that group. What I found probably the most valuable to me as a listener, though, was what I'll call was an unscripted part of the program where Jerry Schauber asked TIC, hey, what do you think about our communication efforts? And I don't know if Rich and Sue recall that conversation, but from a listener standpoint, I thought it was great. Very, again, unscripted. And there was one individual, one woman who made some great comments from a communications standpoint, very thoughtful and yet off the cuff. And I could picture her, but I can't because I wasn't there in person. I wasn't able to pick up exactly who it was. But I thought it was great feedback for Jerry and the PCC to get her perspective from a practitioner standpoint on how communication efforts could be improved, which of course is one of Jerry's big agenda items going in the future, as well as I think the board of trustees will talk about it probably more so tomorrow when we hear more about the PCC effectiveness review report. But I thought that was fantastic. Great discussion. And I know I have to bet Jerry got a lot out of that, and maybe Sue and Rich did as well. Secondly, as always, I'd like to comment on when the FASB members provide some great interaction and direction to the PCC. There was one of the conversations dealing with the debt modification, debt extinguishment project, where Rich did, again, direct the PCC, or direct isn't the right word, provided some suggestions on how they might refine or better define what they might want to do with certain disclosure information. And I think, as you mentioned, maybe looking at the SEC disclosure project as something they might consider. And again, that just displays another aspect where there is that interaction, and where the FASB does encourage the PCC to bring up ideas and provides them suggestions on other projects, or an expansion or a refinement of the project that they have to benefit private companies. And I always appreciate that, and you're always very good about that. So I wanted to mention that aspect of it. So that's all I have.
Well, thank you, Rick, for that report on your observations. As you mentioned, it is, it's nice to observe these meetings, because not only I, as a trustee, or trustees who observe them, learn a lot about the details about topics that are being considered, but you also get to meet the people who are just volunteering and serving on advisory bodies, and really, giving their time and talent to our standard setting process. So it's kind of really heartwarming to see that. With that, the final item on our agenda is any other meeting observations from the trustees in the last quarter. And I know I attended the FASAC meeting on September 19th, so I'll report on that, my observations. This was my first FASAC meeting. And I always thought, like, FASAC is such a large group. I wonder how it works when they meet together. We were assembled in person in that large conference room, and every inch of that table was taken over, because majority of the members attended. There were a few who attended virtually. And the conversation centered around two major topics. The big topic, first, it started out with Rich presenting, and then staff from SEC, PCAOB, AICPA, which was something new for me compared to GASB, presented. And then they moved on to, the committee moved on to the disclosure effectiveness process. That was like half of the day discussion. The council members discussed and provided input into GAAP disclosures, including potential ways to improve disclosure effectiveness, whether there's another holistic approach that the FASB could use to consider disclosures. Also, they were supportive of board's past efforts in developing GAAP disclosures that improve the clarity, conciseness, and utility. Great discussion. What was most interesting was the group then broke into 6 or 7 different subgroups, and they were sent to different rooms with questions to answer. And the trustees who were attending, the observers, also got to be part of one of the subgroups. And it was really interesting how much vigorous discussion took place in those small subgroups. And each group came and reported with either their suggestions for how to improve disclosure process, the number of disclosures that are out there. Some groups suggested maybe GASB might want to consider, FASB might want to consider a table for quantitative information that's included in the disclosure, because sometimes you have to read through several paragraphs to pick out a few numbers. To the extent there's quantitative information, that it could be in a table followed by a more qualitative disclosure kind of thing. So it was really very interesting to see how most members of the group participated and offered their perspectives. There were several new members who too were vocal and participative. So that was, again, impressive. I came away from that meeting just very pleased with a large advisory group, but how they shared their diverse perspectives. They were respectful of each other and really provided some good feedback to FASB on the topics that were discussed. Now, that's my observation. And with that, we have now reached the end of our public session of FAF's Standard Setting Process Oversight Committee meeting. Again, many thanks to those who attended and tuned in to today's webcast. Please note that the next Oversight Committee public meeting will be held in Norwalk, Connecticut on Monday, February 24, 2025. Thank you, everyone, and have a great day.